Andrew DiCapua is the principal economist with the Canadian Chamber of Commerce, and he joins me now. Nice to see you, sir. Thanks for coming in.
Good to see you, JP. Thanks.
So inflation hit nearly 3% in April. It's going in the wrong direction, it seems, after some huge spikes in energy costs, of course. Are you concerned that inflation seems to be creeping up?
Well, there's no doubt about it that inflation is heading in the wrong direction. You know, for the month of April, inflation rose 2.8%. That's up from 2.4% in March. Now, this is largely driven due to gasoline prices rising about 30% on a year-over-year basis just in April alone. Now, the one thing that's pretty clear as we head into the summer months is that inflation, at least when you look at the headline numbers, is really primarily an energy story. You know, when you look at the whole CPI basket, it doesn't seem like this is feeding into other components. But there's no doubt about it that, you know, when it's hot, you feel uncomfortable. And I think Canadians are starting to feel uncomfortable, right? They're starting to sweat a little bit more. It's getting hotter here in Ottawa. We're sweating a little bit more, especially across the country. And so, you know, one thing as well is that, you know, the heat affects people differently, right? And so inflation across the country was also different. We saw Atlantic Canada provinces, you know, in some places like Nova Scotia, New Brunswick, reach 4% inflation. So the reality is that inflation is heating up. Core measures are holding steady, not a major cause for concern right now. But at the end of the day, Canadians are still paying this.
Yeah, you mentioned energy. So gasoline prices were up 28.6% year over year. As you say, nearly 30% in April. That is just like such an eye-popping figure. Right? That has to be one of the biggest spikes on record in such a short period of time, right? How is that affecting consumers? Like, how is that playing out in the economy? Obviously, we're looking at numbers on the page. When people go to the pump, that's really hurting, you know, them and their pocketbooks. Do you see that being a real drag on the economy moving forward?
Well, there's no doubt about it. This has been one of the largest energy shocks that we've seen in recent history, right? You'd have to go back to the Russia-Ukraine invasion in 2021 to see something of a similar magnitude. And it's not just energy, right? It's fertilizer prices. It's a whole suite of commodity prices that are, you know, the longer that the Strait of Hormuz remains closed, there is a risk that this is going to feed into inflation. You know, you look to the United States, they're posting 3.8% inflation, so it's hitting the United States particularly hard. But back to Canada, Canadians, you know, gasoline is one of those price signals in the economy that when they're driving by or filling up the gas station, they see that and it creeps back into the thoughts back in 2021. So there's no doubt about it that inflation expectations have risen. Longer-term inflation expectations, which really drive, you know, longer-term inflation, still remain somewhat anchored. But in this environment, there's no doubt about it. Costs are going up, risk has increased, and that creates more uncertainty, which is difficult for both households and businesses to plan.
As you mentioned, there were maybe some bright spots, I guess we can call it, in this print, right? We saw that, yes, there's been an increase in rent, but it's not quite as what it was the month before, right? The increase was actually smaller than we saw in March. Food inflation has also moderated a little bit, at least when you look at the national numbers. Maybe regionally there are some differences there. But do you think that we're maybe on a better trajectory elsewhere? I mean, excluding energy, we just talked about how punishing that has been. Do you think that when you look at the other metrics, some of the other things in that basket, that inflation is maybe at a more reasonable level? Is that fair to say?
Yeah, it's a great point. Let's just take a step back for a moment. About 38% of the CPI basket is growing above 3%. And that has been declining consistently since December. So we're seeing that even though we're seeing headline inflation hit 3%, when you take out gasoline, inflation is growing at 2%, the Bank of Canada's target. Right. Core measures, which the Bank of Canada pay particularly close to, are actually improved from March and now are growing at 2.1% on a year-over-year basis. So those measures are going to be really important as we head into the summer months, where we could be getting close to a 3 on inflation, at 3%. And that could be a little bit of a cause for concern.
Yeah, I mean, some people who are concerned today are the traders on Wall Street. I don't know if you saw it today, but U.S. Treasury yields spiked, right, hitting, I think, a 19-year high it was. So obviously folks are expecting there might be an interest rate hike stateside. Do you think that that's something the Bank of Canada will have to consider in the coming weeks, in the coming months? Will there be potentially a rate hike in this country as a result of some of the inflation we're seeing, especially as it relates to energy?
Well, you bring up a good point because financial markets, particularly bond yields, have increased over the last couple of months. That's been largely due to what's been going on in the Middle East, right? That increase in risk has bond yields are increasing as a result of expecting inflation to be higher than previously expected. So the Bank of Canada acknowledges that headline inflation is going to be higher than expected. Businesses expect inflation to be higher than expected at least this year. And so bonds are definitely responding in line. Now, the one thing about expectations on interest rate hikes, markets after the news of inflation coming today actually pushed back rate hike expectations, which were slated for September at the earliest this year to happen, now to October. So clearly markets viewed this as good news, despite, of course, the energy spike there. And so we don't expect rates to move at their next meeting. But of course, the Bank of Canada points out that oil and what's happening around trade are really the two key things that they're looking at in terms of what's going to happen for rate moves.
Let's talk about trade, of course. We know that we're facing this July 1st deadline for a review of the Canada-US-Mexico agreement. We've heard Jamieson Greer, the U.S. Trade Representative, we've heard the Prime Minister in this country say, we might not actually reach a deal by July 1st, but things will keep moving along because the deal doesn't necessarily end if they can't get to a review. But what do you think that means for rates, for the economy, for all the things that we just talked about, with that hanging over our heads, with the prospect of not having something locked up with the Americans? Do you think that that puts the economy on shakier ground?
Well, I think one of the unfortunate realities is, or maybe if you look at this as a positive, is that the expectations are low for the Canadian economy, right? We are expected to grow, by the Bank of Canada estimates, 1.2% this year. And yes, you can compare that to G7 colleagues, but that's very low growth. That's just a touch below potential, which has been revised down. So that's not great growth. So really, at the end of the day, anything better than what we have right now will be a win. Now, the key thing here is maintaining what we have right now. Of course, there are certain sectors that are being hit particularly hard. I think also the key message to take away is that tariffs are here to stay. Okay, the era of free trade, expanding free trade, is over, and we're in a much more managed trade environment where there's going to be these sector-specific deals. There's going to be a lot of details and minutia that we don't really want to get into, but again, it's going to take a lot of work. And so I don't think the July 1st deadline is particularly going to be one that we're going to meet. But we've got to keep talking. We've got to stay engaged, because there's one thing that we know the Americans love. They love to stay engaged, and we got to be there ready to play ball.
Yeah, absolutely. Let's leave it there. Andrew DiCapua, a principal economist at the Canadian Chamber of Commerce. Nice to see you, sir. Thanks for coming in.
Thanks so much.